Welcome back to Dollars and Cents with Friedman Financial on North Shore 1049. My name is Mark Friedman. I'm President and CEO of Friedman Financial, located in Peabody, Massachusetts, where we provide financial advice in a language you can understand to individuals and families who live all throughout the North Shore, the Merrimack Valley, and the southern New Hampshire area. We've been doing this since 1968. 3 and 4 generations of families have worked with us, and it's been my pleasure. It really has been an honor to be able to meet so many families. You know, we're dealing with issues from birth to death. It's really everything. I know today we're talking a lot about investments, but oftentimes in other parts of our shows we will talk about, you know, how do we prepare for that transition in life when we lose a spouse, for instance, dealing with death, dealing with retirement, dealing with Social Security. How do we save for our kids' education? How are we more prudent with how we're managing our resources so that we have enough money in retirement? We talk about all of that stuff. But all of those things that we talk about and what we're talking about today are oftentimes psychological and behavior-related issues. It's important that we understand, why do we do what we do? And oftentimes it's more habitual. Oftentimes it's because that's what my friends do, that's what my mom and dad taught me to do, or that's what just I think is the right thing to do for now. Or sometimes it's because I want to be a rebel and do something different. Well, one of the things we're talking about today is a report that came out of Dalbar. Dalbar is one of the industry-leading organizations that does market research on investment behavior and all sorts of things as it relates to money and benchmarking studies. Well, the annual study that they put together is called the Quantitative Analysis of Investment Behavior, of Investor Behavior, I should say. What they do is they look at how did individual investors, people who choose to invest either through a financial advisor or on their own, how do they perform compared to market indexes? And the report is really no different for 2018 than what it was in 1970. The results are generally the same. It's impossible to beat the S&P 500. It's impossible to beat any index unless you buy the index. And the reason for that is because as human beings, we are emotional. We make decisions based upon emotions rather than a computer, which is essentially the S&P 500. It's a quantitative machine that manages a fixed set of 500 stocks that are market weighted. There is no emotions attached. When Trump says that we're going to impose tariffs of 15, 10, or 60% in China, the S&P goes, they're really not interested. It's not a big deal. They cannot make a change. It's fixed. But you and I will react. When we hear that Christmas sales are down, or the price of gas is going up, or or unemployment is up, or it can be anything, we react. Because maybe our job situation has changed. Maybe the conversations we're having with our children have changed. Maybe we can't afford to live in our house anymore. Whatever it might be. Or things are getting better and we react differently as well. The S&P 500 or any index is totally emotion-free. They are absolutely the truest sense of unbiased. And the minute you put emotion in your investment decisions is the moment when you run the risk of underperforming an index. So earlier in the show I talked about this bullet that said in 2018 was not a good year for the stock market. Now you just may remember the last 3 months where the market was down 19 point something percent. It was just under 20, so we couldn't call it a bear market. We could still call it was a correction. Market was okay in 18, then it dropped towards the end. At the end of the year, the S&P 500, as managed by Standard & Poor's, of 500 stocks that are market weighted, S&P 500 was down negative 4.38% for 2018, a negative year. But the average investor who wanted to invest in stock-based mutual funds, who wanted to try to beat the market, the average investor was down 9.42%. And the reason was, you got in, you got out, this fund was underperforming. I saw this in my 401k. I saw the quarterly report. This fund's not doing so good. I'm going to add something. I'm going to move it. Every time you added money, you impacted your performance. Every time you took money out, you impacted your performance. Every time you made a change, you impacted performance. In fact, individual investment performance is one of the hardest measurements to measure, because it's what's called an internal rate of return calculation. You have to look at performance every single day, where the money was added, where the money was taken out. You should never try to compare the performance of your 401k plan to an index, because in your 401k plan, you're generally adding money every week, every pay period, every month. And so if you're doing that, let's say your 401k had $100,000 at the beginning of the year, and at the end of the year, it now is worth $110,000. You might think to yourself, oh my goodness, I made 10% on my investment. But what if you now look at the details and realize that you added $8,000 over the course of the year through salary reduction? So isn't your growth really only $2,000, not $10,000? Eight of that $10,000 in growth came from you adding more money. But you might see, well, the S&P 500, if you had invested $100,000 in the S&P 500 at the beginning of the year, and now at the end of the year it's up to $105,000, you might think to yourself, man, I'm pretty smart. I just outperformed the S&P 500. I have $110,000. Well, you really didn't. I hope you understand that. The S&P 500 grew $5,000 in this example, $5,000 only due to growth, because nothing was being added, nothing was being taken out. It went from 100 to 105 for the year. Your account that started with $100,000 and is now worth 110 only grew $2,000 because 8 of it was through salary reduction or through your employer match or whatever it was. That doesn't make you smarter than the S&P 500. And you know, I don't want to just pick on the S&P 500 here. Because what if you said to yourself, well, I just invest in bonds. Well, how did the average bond fund investor do? In 2018, the average fixed income fund investor underperformed what's called the Bloomberg Barclays Aggregate Bond Index. Just like we have the S&P 500 for stocks, the Bloomberg Barclays Aggregate Bond Index is the bond index for fixed income securities. The Bloomberg Barclays Aggregate Bond Index for 2018 was up, get this, up, big number here, up 0.01%. Can we just say it was flat? 0.01%. That's basically, that's if you had $100, you grew a penny. Come on, let's call it flat, okay? But the average investor who invested in bond funds underperformed the index by 2.84%. They came in at negative 2.84, where the index was up 0.01%. Same thing happens with bond investors, because oftentimes bond investors are saying, well, this is my safe investment. Or they're thinking it's the safe investment. They say, well, I might need $10,000 for my account. Maybe we'll take it from the bond fund. Or maybe I'm adding money. Or people said, CDs were so bad in 2018 that maybe I want to add some money to my bond fund. So they added money in the middle of the year. And interest rates go up and interest rates go down. But if you've been listening to this show, you know that one of the things that I talk about is the importance of asset allocation. Having some money in stock funds, some money in bond funds. And when I say stock funds or bond funds, I'm just not talking about mutual funds. It could be exchange traded funds, it could be index funds, but something that gives you professional money management, great amounts of diversification, liquidity, and pricing that you can see on a daily basis. That's important. Oftentimes, we find that many of our clients enjoy a portfolio that's, let's say, 60% in the stock market, 40% in the bond market, using a collection of investment strategies. Well, how did that group do? If you were the average asset allocation investor, or let's just call yourself the average asset allocation fund investor, someone that buys that target date fund. Maybe you have that in your 401k. So that might be one fund that's 60-40. Oh, the average balanced fund investor. Well, the average asset allocation fund investor, I'm going to find it here, lost 6.97% in 2018. 6.87% compared to the S&P 500, which was down 4.38%. So remember I told you earlier that if you invested all of your money, if you were a stock-only based stock-only-based investor, for 2018 on average you lost 9.42%, where the S&P 500 was down 4.38%. If you decided to go the asset allocation route, 60-40, you were down on average 6.97%. Certainly not as much as the 100% stock investor, but you still underperform the S&P 500. But here's the thing that I find fascinating. When you go to pick an investment, when you're doing all your research and you're talking to your financial advisor or doing it on your own, you might go to Morningstar, you might go to Bloomberg, you might go to Value Line, you might go to Yahoo Finance. I don't care which research company you go to. And what is one of the things that you're always looking at? People are looking at, well, what's the 5-year return? What's the 10-year return? What's the 15-year return? How is this thing done? And we all make our investment decisions based upon that. We think to ourselves, well, I understand this account's going to go through ups and downs. There's going to be challenges. There's going to be economic shifts. There's going to be recessions. There's going to be economic expansion. There's going to be all sorts of things that happen. But if I can buy a fund that has a great 5-year, 10-year, or 15-year track record, I should do just great. I should do just great. But there's a problem with that. And that comes from a report that Davlar just reported that talks about the retention rates. How long do you actually stick with the investments that you buy? You want to learn more about that? Well, that's where we take a break. And that's what we'll tease you for our very next segment. You want to know how long the average investor sticks around with a mutual fund, an exchange-traded fund, an index fund, what we call a retention rate? Will you stick around? We'll be right back. You're listening to Dollars and Cents with Friedman Financial on North Shore 104.9.